I not said that life is ups and downs many times. If you understand that, I swear to God, you are an economist, a real classical essential economist. If you understand boom bust, högkonjunktur, lågkonjunktur in Sweden, because the economy works like this. And I swear to you, most people who do risk models in bank, they don't get it. They don't get it because they come straight from school, but they never study economics. They don't think about what they actually study. So they don't understand these fundamental principles. When times are good, everything is growing, small business is booming. That is when you make risk models to calculate for the losses that you have in negative periods, so-called economic downturns in regulations. So you save money in good times or capital to buffer for what crap can happen in very difficult economic times. That's why all your risk models should be based on very rare losses that you have in difficult economic times, such as the 90s crisis. What about the subprime crisis 2008? No. You cannot model risk based on the subprime crisis 2008 because there was no real economic damage. It was just speculation. A bunch of investment bankers on Wall Street who sell crap, but they price it AAA, meaning that they say they sell it as really good stuff, which is packages of mortgages essentially, but it's really toxic stuff, high default, high risk stuff, but they say it's good. So they sell you a broken car, but price it as a good car, and everyone believes that, and everyone buys it, and there is a bubble, and then eventually, because there is no reality to what they sell, essentially the market balances, and a lot of people lose money. So that is what happened, and that's just speculation. That's not an economic crisis. An economic crisis is when you actually have large unemployment, like the 90s crisis. So you have to make risk models that hold enough capital so that you can survive a 90s crisis. If you get this right, you can make good risk models that get regulatory approval. If you don't get it right, which most don't get right because people don't understand the sinus curve of how life works. You have expansion, contraction, success, failure, wins and losses. They don't understand that yin and yang setting of the business cycle. So they, in good times, they don't want to hold capital. They capital optimize. Save as little as possible to invest more and more and get more leverage and earn more money, because they think of the economy like this, that it is always going to go upward. That's how people think about the economy, like linear, like it's always going to go upward, but it's like this. So they get greedy in good times, and then when the economy essentially fails, which it has done for the last 3,000 years, it has gone like this. When they are in bad times, they don't have any money. So they lose a lot of money, and what happens then? They go to the government and say, we don't have any money. We have losses. Our equity is being eaten up. So the government has to bail them out. It's JP Morgan, that's Nordea, that's so many other banks. So this is the essential of it. If you understand this, boom, bust. Growth, contraction. Economic uptime, economic downturn. You understand risk and you understand economics at the basis, and your risk models are based on keeping enough, save enough money in good times so that you have a buffer for bad times. And if you have that, when there is an economic crisis such as which can come as a result of COVID-19, you will have enough capital savings so that you can absorb those losses, all those small businesses that have loans in your bank that go bust, or all those mortgages that the people, they lose their jobs so they can't pay the mortgage, so they default on the mortgage. So you can incur those credit losses and still be up and running. Assalamu alaikum.